In this video, we're going to talk about the current cash debt coverage ratio, which is an important measure of a firm's short-term liquidity. Now, you might be thinking, why do we need another measure of short-term liquidity? Don't we have things like the current ratio? And then we've also talked about the quick ratio, where we factor out the effects of inventory. Don't we have these things here? Why do we need another measure of short-term liquidity? Well, when we think about the current ratio and the quick ratio, basically what we're trying to get an idea with those ratios is whether the firm has enough in its most liquid assets to satisfy the obligations that are going to come due in the next year. But with the current cash debt coverage ratio, we're instead looking at whether the firm generates enough cash from its operations, not its existing assets, but the current operations. Do they generate enough cash to satisfy those obligations? So it's just a different way of looking at this idea of short-term liquidity. That being the case, when we have our equation to compute our debt coverage ratio, we're going to have in the numerator, instead of some kind of asset total from the balance sheet, we're going to have something from the statement of cash flows, and that is cash flow from operations, which we can just abbreviate as CFO. Cash flow from operations, or if you prefer, cash flow provided from operations. It'll be worded various ways on the statement of cash flows, but we're talking about the same thing. This is the main cash that is generated by the firm's core business operations. So we have that in our numerator, and then in the denominator we again have current liabilities, and we can even look at it in terms of average current liabilities, where we just take the current liabilities from January 1 and current liabilities from December 31 and then divide by 2, or you can just use current liabilities if you prefer, but ultimately the idea is that we're looking at cash that we're generating from the firm's operations, the main operations, not how much it raises from equity issuances or anything like that, the main core operations, and then in the denominator we have current liabilities. If we take a look at an example of how this ratio, this debt coverage ratio, would play out for a couple of sample firms, I can just put some numbers to it and it'll give you an idea how we can interpret the ratio. So let's say that firm 1 had $1,000 in cash flow from operations, and then firm 2 had $1,800, and again these numbers would come from the statement of cash flows, the net cash provided by the firm's operations. And then in terms of the average current liabilities, let's say that firm 1 had $800 and that firm 2 had $2,400. And then the current cash debt coverage ratio, we're just going to take cash flow from operations to be in the numerator, so we're going to divide it by the denominator, which is average current liabilities. And for firm 1, that's going to give us a current cash debt coverage ratio of 1.25. And then for firm 2, taking $1,800 and dividing it by $2,400 is going to yield a coverage ratio of 0.75. And similarly to the current ratio and to the quick ratio, to these other ratios, a higher ratio implies better short-term liquidity. So in this case, firm 1, based on its operations, the cash flow from operations, kind of ignoring current assets or its most liquid assets and just looking at the cash it generates from its operations, firm 1 has better short-term liquidity, a better ability to satisfy its short-term obligations than firm 2, because it has a higher debt coverage ratio.